The markets are breathing a sigh of relief as a deal has been tentatively arrived at to avert the debt default disaster. But is it possible that markets are taking their victory lap a little bit too early? Because right now, the federal government's checking account is drained, which means that once this deal is finalized, or any deal is finalized, the government will be forced to go on a giant borrowing binge. But where is that money actually going to come from? Who is going to be the one to lend those hundreds of billions of dollars to the government right now? Real quick, a word from today's sponsor, McAlvany Precious Metals. It's no secret that today banks are falling like dominoes. So the question is, how do you know if your bank is safe? In times like this, the name of the game is always counterparty risk, which is essentially just the degree to which you have to trust or rely on somebody else to give back to you what they promised they will give to you. This is why investors like investing in things like physical gold and silver, because if you have it, you don't have to trust that somebody else will give it to you. This is not the case with banks though, which today means many people are asking the question, is my bank safe? Can I trust my bank that they'll give me back the dollars that they owe me? This is where the McAlvany Trusted Precious Metals Advisors come in. Right now, they're offering a free consultation with you in order to go over your bank and provide you a detailed analysis on whether your bank is stable and safe. They do this by providing a bank safety rating, which is a composite of hundreds of factors synthesized into 5 indexes: the bank's capitalization, asset quality, profitability, liquidity, and stability. Putting these all together, you can see what your bank is invested in to learn whether your bank is safe, is stable, and has liquidity that it needs. This will give you the information you need to make an informed decision about what you should be doing with your portfolio and your investments. The expert precious metals advisors at McAlvany Precious Metals are here and ready to assist you in analyzing your bank, looking over your cash holdings, and making individual personalized recommendations for you about your investments. Sign up for your free bank safety rating consultation with the link in the description below. So what exactly are the details of this debt deal? Well, Democrats are not exactly happy with this debt deal, but the White House is communicating that it could have been a lot worse. Basically saying that Republicans were asking for a lot more spending cuts, and the compromise that they were able to arrive at got rid of most of these spending cuts. The first thing to note is that it is a debt limit suspension. So this is different than raising the debt ceiling to a predetermined amount. This is just saying, hey, that ceiling that we've been talking about, we're just going to suspend it and it's no longer going to be there. This means that whatever borrowing does take place gets to take place without any worry to any limit or ceiling. And this suspension will go through January of 2025. The next thing to note is that the only spending cuts or limits take place in the discretionary part of the government's budget. There are no changes to the mandatory spending categories like Medicare, Medicaid, Social Security, but instead the discretionary portion of the budget is the one that gets the cuts. But even saying that goes a little bit too far, because these aren't actually spending cuts. These are cuts and limits on the increases that they were going to have in spending in those categories. For instance, there is now an $886 billion cap on security spending when it would have risen to $895 billion. And there is a $704 billion cap on non-security spending when it would have risen to $711 billion. Essentially, when you add it all up, there is no meaningful cut to any federal government spending here. The government is still going to have to run massive deficits, which means hundreds of billions, in excess of $1 trillion of borrowing just to keep running. This is mortgaging our nation's future. We are spending money that we literally do not have for things we do not need, that most Americans do not want. And the government is becoming a larger and larger burden on the backs of working Americans. We have the choice of intentionally choosing right now to take the short-term painful option, cut government spending, or if we don't, we will be forced to cut government spending when our nation economically collapses at some point in the future as a result of borrowing all that future purchasing power and spending it in the present. And unfortunately, after this deal, we know what route our current politicians have chosen yet again. But as most people know, no, that is not an immediate issue. That's not a next 6 months, next couple of quarters, probably not even a next couple of years, which is why politicians always choose that. But there is a more pressing issue. Once they are allowed to start borrowing again, where is that money going to come from? Who are they going to borrow from? Because they have to refill their checking account. This is the Treasury's general account, which operates just like their checking account. When they borrow money or receive money in taxes, this is the account it goes into. And when they spend money, this is the account it goes out of. Now, the purpose and the use of this account has changed over the last couple of decades, but ever since about 2016, you can see that the amount in this account the government has wanted to keep around the $400 billion mark. There was obviously a big spike in the beginning of 2020, and that spike came from when they borrowed a few $1 trillion to spend all the money they wanted to spend for COVID. That money had to come in first, and then they started spending it. So there was that big spike before they started spending. And then Biden got into office around January of 2021. That was before most of that money had been spent. And Yellen at the time said, hey, we don't want to do any additional borrowing to fund our government's expenses. We're going to spend this account back down to its normal level of about $400 billion. That's exactly what they did. And unfortunately, around that time, there was a debt ceiling issue at the time. And so this account got drained. After that was resolved, they built the account back up to the $600 billion level or so by borrowing an additional $500 billion or so immediately. The next debt ceiling issue happened right now. The account got drained again. And so now we can expect that just like Yellen has always wanted, she's going to borrow another $500 billion or so to get this account value back up to where it's comfortable for her. Now, all of this additional borrowing, people are drawing parallels to when the repo market broke in September of 2019. When the federal government suspended the debt ceiling in 2019, they had to refill their checking account again, and all that additional borrowing, which is at the time only a few $100 billion, which at the time was only a couple $100 billion, they drained liquidity from the system. There wasn't enough money out there, and so that caused the repo market crisis in 2019 that the Fed had to step into and start not QE in order to bail out the repo market. But I'm going to show you why that's not going to happen this time with only $500 or $600 billion or so of federal government borrowing. Because ever since April of 2021, money has been flooding into a facility at the Fed called the reverse repo facility. Basically, banks operate with each other like a giant pawn shop. And so if a bank needs cash and they have assets or they have collateral, they'll say, hey, does anybody want to buy this collateral from me so I can get the cash and I promise to repurchase it from you at some point in the future? So that's why it's called a repo market. Banks will buy and sell cash and collateral from each other overnight and promise that they'll repay it, repurchase it from each other in the future. In 2019, there was not enough cash in the system. Everybody needed cash. Everybody had collateral. So the Fed stepped in and printed as much money as was needed for those overnight markets. This facility is the opposite. This is the reverse repo facility. So this is when everybody in the system says, I've got a bunch of cash and I need collateral, and everybody has the same situation. They have cash but no collateral. They've got nowhere to go. So the Fed opened up this facility, the reverse repo facility, so that banks and financial institutions can get their collateral from the Fed. The way that the Federal Reserve incentivizes financial institutions to use the reverse repo facility instead of buying that collateral from the open market is by paying a fat interest rate, which is currently at 5.05%. Now, if you put money in the bank, you do have some risk that that bank will collapse. If you loan your money to the government, it's considered risk-free, but you still have the risk that the federal government will default on that debt. If you have the ability to loan money to the Federal Reserve, well, there's no politics there. There's no chance of default. They are the money printer. And so being able to put money in a facility that pays you 5.05% risk-free, there is nothing like that anywhere else. So obviously any money who wants to take advantage of a high interest rate for actually risk-free, they're going to do it. And that's why there's $2 trillion currently sitting in the reverse repo facility. This money comes from financial institutions, money markets. And so when you put your money in a high yield savings account, in a high yield, high interest money market fund, that's where this money ends up. Right now, interest rates on short-term debt from the US government are in between 5 and 6%. So right now there are funds, there are savings accounts, there are money market funds who want a little bit of a mix. They want the risk free from the Federal Reserve, and they're taking some of that cash. They're loaning it to the United States government on these short-term bills so that they get a little bit of a higher return. But when the federal government has to refill this checking account that they have and has to borrow $500 to $600 billion overnight, that's going to be a flood of new debt on the market. As we know that debt prices and interest rates are inversely correlated, this means that rates for short-term debt are going to push higher very quickly as a result. So these short-term interest rates for the federal government's debt could exceed 6%, maybe even move higher. So ultimately, we don't know how high they will get, but at some point, the risk to reward ratio starts looking more beneficial to loan the money to the government instead of keeping it in the reverse repo facility. The 5.05% that the Fed pays on the reverse repo funds represents a floor underneath interest rates. So you're definitely not going to take on more risk to get paid 4% when you could take on zero risk to get paid 5%. But if the federal government suddenly starts offering 6%, 6.5% on short-term debt, well, hey, that's attractive enough then where money might start leaving the reverse repo facility and being loaned to the US government instead. And seeing how there is $2 trillion that's currently getting paid 5.05%, there's plenty of liquidity in the system for the federal government to be able to borrow $500 billion, $600 billion just to refill that account and then continue its borrowing for its additional deficits for at least a year, maybe 2 years. So liquidity is not an issue yet, but depending on how big those deficits become, we could see liquidity become an issue at some point soon, especially because the Federal Reserve is still fighting inflation with quantitative tightening. And this is where the real problem presents itself. Really long term, we have the problem of bankrupting our nation. Shorter term, next couple of years, we have the liquidity problem from these really, really high deficits driving up inflation. Meanwhile, the Federal Reserve is sucking liquidity out of the system as well to fight inflation. These two opposing forces are stagflationary when you add them up together. But the real problem here is crowding out. And this is the short-term risk that markets are not paying attention to right now. Put your ear to the ground and start looking at what people with big money are doing. Right now, they are not making high-risk loans, high-risk investments, spending money on things that could produce a decent amount of wealth in the future. They're playing it safe. They're selling their stocks, they're paying off the debt on their real estate, they're saving money, they're putting it in high yield savings accounts, money market funds, loaning it to the government in T-bills, which means far less capital available to the private sector. When the Federal Reserve is paying 5.05% and the federal government is paying in between 5 and 6%, are you going to risk a 20% loss putting your money in the S&P 500 for an average annual return of 8%? The retail investor is still doing that, but big money is not. That risk-free rate is very attractive right now. You're not going to take on risk of a 10, 20, 25% drawdown just for an extra 1 to 2% average annual return. So the system is currently shifting towards incentivizing saving, which is good during a time of inflation because it helps battle that inflation as people spend less money. But people are still being forced to spend the money on the stuff that they have to, which continues driving up the prices in those things what people need the most. And so we have high inflation in the necessities, we have high government deficits that are contributing to a reduction in overall wealth as the government is a giant burden on the economy, and we have less capital available to the private sector, which results in, again, lower amount of wealth overall because of this crowding out. And that is the immediate risk that I see, and that so far it does not look like markets have fully realized. And as rates move higher and the government borrows more and more, this crowding out effect will only become more pronounced. And so there are certainly assets right now that are attractive. Valuations in some assets have gotten to a point that are attractive. You can buy when there's blood in the streets. I teach my members of Heresy Financial University how to do this. Link is in the description below. But the broad markets are not anywhere close to that yet. And it seems like we may very well have more pain ahead in broad asset prices. So for me, it's still risk off for now. As always, really appreciate you guys. Thank you so much for watching. Have a great day.